Welcome everybody. Time is surely flying. It's Wednesday morning in Australia, Tuesday for the Americans, and somewhere between Tuesday and Wednesday for the Europeans. So it's time for an early to mid-week recap. Stocks continue to go up, proving Isaac Newton wrong. What goes up doesn't have to come down. Bears have over $40 billion in margin call to pay before the end of the week. So it looks like the extinction of the bear is finally upon us. And 55% of S&P 500 companies is under SEC investigation. So this is why we're not at 6,000 yet. And also, Tom Lee's back to being ultra bullish.
Tom, in recent appearances, I would say that your conviction hasn't necessarily been quite as strong as it had been in some of your other calls. Now I think you're saying it's been more stable than what you were expecting.
You're right. We've kind of been sort of, I think, fooled by seasonality because we thought markets would be hesitant before the elections, and it's October, but we've seen this market be incredibly resilient. So I've underestimated how strong this market's been.
Welcome everybody to the Daily Recap Show where we talk about stocks and the financial markets. My name is Chase. If you like this video, please subscribe, hit that notification bell as well as the like button and leave a comment for the algorithm. Let's get into it. This is the daily heat map of the S&P 500 and a lot of red, a lot of green, a very bifurcated market today with losses being led by energy as well as tech stocks. However, Apple bucked the trend up 1% on the day, but anywhere else tech was either down to flat, led by some of the losses in semiconductors. Nvidia down 4.69%, AVGO followed suit, AMD, Qualcomm. That had to do with some of the regulation news in that space, as well as ASML's earnings. However, financials showed relative strength after some very strong earnings today, and then it was mixed everywhere else. Industrials were kind of red, very mixed year in healthcare. Consumer staples and cyclicals were kind of green, but really today's market was a stock picker's market. If you were in the right stocks, you did well. If you were in broad-based indices, you didn't do too well. And that's because when Nvidia and semiconductors show weakness, the broad market will show weakness. And Nvidia today sank more than 5%, partially reversing its 2-week rally and coming down off its record close yesterday. The stock tumble came after a Bloomberg report showed that the Biden administration is considering capping US chip exports to certain countries. What also didn't help semiconductor stocks today was ASML's earnings. Their earnings is supposed to drop tomorrow. It was released in error today. Apparently there was a glitch on their website. Regardless, earnings dropped today and ASML's bookings came in really bad. They lowered their 2025 sales forecast, their booking forecast, and the company said that despite a boom in AI related chips, other parts of the semiconductor market are weaker for longer than expected, making leading companies to delay orders and only plan limited new capacity additions. ASML was down 15% after that news. However, guys, when we look at the broad spectrum of earnings was very good today. Bank earnings, healthcare earnings. Look at Johnson & Johnson and United Healthcare. Earnings surprised by 2% and 9% respectively. Then looking at Bank of America, Goldman, Schwab, Citi, PNC Financial Services, State Street, they all beat expectations handily, up 6%, 21%, 2%, 15%, 5%. This is earnings surprise versus analyst expectations. State Street beat here too, and they all beat on revenue expectations as well. Very strong earnings across the board. However, when you actually look at the performance of financials today, they were kind of in the middle of the heap, maybe going to show that that sector is now fully valued and these earnings are sort of just churning away at the valuation. Nonetheless, still outperforming the S&P 500 by a wide margin. The S&P 500 fell 0.8% here today, and only 3 sectors underperformed the SPY, but the technology sector, the energy sector, and the healthcare sector really pulled down the overall market. Industrials and materials lost as well, and then every other sector did gain. So about half the sectors did gain on the day, half did fall, but the best performing sector was real estate. And that's because on the back of everything we saw today, yields actually fell significantly. When yields are going to fall, rate sensitive stocks are going to gain. And the major proponent of that is just real estate, up 1.25%. And that's why we actually saw small caps outperform mids and large today. A huge proponent of small caps is financials and REITs, particularly regional banks and companies that are exposed to rates. They outperformed today, particularly small cap value. The only green factor, however, core and value were virtually flat on the day. Mid caps were slightly worse. However, they definitely outperformed large caps, but large cap growth was the real loser here today, down 1.36%, led by Nvidia, large cap core as well. We actually just saw like the entire growth proponent of the market, but really value and core factors were sort of keeping things together. However, if you get sustained weakness in large caps, you're going to see sustained weakness in the overall market, particularly in the US. However, market breadth still looking very, very constructive. Yes, we did pull down from yesterday's highs in the shorter term averages, the 5-day, 20-day, and also from the 50-day. However, things looking still very constructive. There's nothing really to be concerned about with this pullback. It just looks like a garden variety pullback led by news-driven events, stuff we heard from the Biden administration, as well as the economic data today. I think the market will probably brush those off very easily because companies find ways to work around those regulations. Nonetheless, shorter-term averages look healthy, medium-term averages look healthy, longer-term averages look very, very constructive. I wouldn't want to be short in this market, but let's hop on the charts. And stocks across the board fell. The S&P 500 down 0.76%, the Nasdaq down 1.73%, the Nasdaq 100. Very brutal day. However, small caps were the outperformer. Virtually a flat day for the IWM, slightly upbeat in extended hours. The SP 600 was also up 0.11%. Small cap quality gained about the same today. So, small caps, the outperformer, and that's because yields came down significantly. The 2-year, 10-year, and 30-year yield fell. Rates sensitive, high beta names are obviously going to gain on the back of that. The dollar was largely flat, and that also did help the overall sentiment. Bonds gained as a result, and after the news, especially the global news, we saw gold and silver gain. Gold was up 0.5 percentage point, silver up 0.83%, and crude fell today, and that didn't help the price action we saw in energy. Energy stocks had a brutal sell-off on the back of a pretty ugly day in crude, but let's actually look at the S&P 500. Very interesting. A lot of people are going to say this is a bearish engulfing candle. I guess you could say we didn't quite get the top of yesterday's wick. However, still an engulfing candle nonetheless, still in positive gamma. That just goes to show the type of environment we're in right now. If we get bad news, especially when we're fully valued in stuff like the indices, we are going to see a significant move to the downside. Whereas when we get like bad news and we're like 10% down from the highs, we can get bad news and actually still rally to the upside. And that's the problem with being at all-time highs. Things need to be perfect for things to keep going in that direction. Earnings need to be perfect. The news cycle needs to be perfect. The macro needs to be perfect for stocks to go higher. However, when you do buy stocks at a discount, things don't need to be perfect. They just have to be good enough. Now, the Nasdaq 100 actually found support at its gamma flip zone. If we see continued weakness in Nvidia, semiconductors, we could definitely be in negative gamma to end this post-OPEX week. Very interesting to see. However, we did see some bulls come in, a little bit of buying here out this week. Regardless, still an ugly bearish engulfing candle, just shy of all-time highs. And the problem we now have, if we start selling and we actually close below the 19,600 level, right? This is going to be a higher low just off all-time highs. And then we could actually see sustained downside in the month of October for the Nasdaq 100. That's definitely something you don't want. Bulls need to really get their shit together and move higher, break this high right here. Otherwise, this price action is going to look very, very ugly. And people are going to start saying something like an equal lower high. You don't really want that. And then we could actually see some of these lower levels, but we'll see how it pans out. We'll see if this is just a one-day event or if this is going to be sustained weakness, particularly with those ASML earnings. I don't think the market was too happy with what they saw, particularly in the semi space, because the semiconductors have really been driving the market. Nonetheless, we are still in positive gamma. That means you buy dips, sell rips all the way to the core resistance. And this could be a favorable position to get in, assuming the fundamentals and the news cycle hold up. The IWM actually found resistance. Let's go to the RTY. The RTY actually found resistance right here, pretty much at its 52-week high. So it didn't quite make a wick high, but it made an equal high, I guess you can call it on a wick basis. That's a 52-week high for the IWM at the core resistance, pulled back significantly from there. However, still positive on the day. And now this is really looking like a higher low, but the IWM really has to hold this 2205 area and then go from there. Ideally, what I want to see is just a move up, maybe like yields come down tomorrow, move up, close above these wick highs in the IWM. If that can happen, that's very constructive, because that will be a 52-week closing high, confirming this higher low, and then we could look to higher prices in the IWM. However, that needs to happen first, and based on the selling we saw, look at this wick, there wasn't a lot of conviction in the bulls to hold price up there, and they kind of just took profits at these 52-week highs, which means there was a lot of supply right here, a lot of weak longs at these areas, which probably got out at this core resistance. We'll see if a lot of those weak longs actually entered on the bottom wick right here. If that is the case, then the IWM can go higher. However, very, very mixed price action. But the plan we follow is that we sell the core resistance, buy the put support, buy dips, sell rips at the gamma flip, sell into weakness below. And that's exactly what we did. We bought dips, rallied all the way to the core resistance, and now we're seeing resistance from it. Nothing we didn't expect. The market doing exactly what it really should be doing. However, the truth is we really do like if stocks just continue to move higher, because we generally have a bullish lean on this channel. Regardless though, looking at stuff like gold 2661, I still continue to believe we're sort of just building out a base. This could last for like the next 2 to 3 months for the next quarter, and build out a base right here, and then we're going to make the next move to the upside in gold. We could go down, but I do think we're going to see bullish momentum in gold, particularly after rate cuts. That does tend to happen. However, gold can go on very long consolidation periods like we saw here, and like we did for most of 2024. This was a very, very long consolidation after we had a huge impulse here in March. So we could be in the early innings of something looking like this before making the next move higher. However, I am still very bullish on gold. I'm also bullish on silver. I think silver is going to outperform gold over the next 12 to 18 months. But having a small 1 to 2% allocation to commodities, not a bad idea. And guys, looking at the S&P 500 right now, still in positive gamma, and you want to buy dip, sell rips. The gamma flip zones haven't really changed. We'll see if they change tomorrow. Regardless, things looking very, very constructive fundamentally from a breadth perspective for the S&P 500. And any dip we do get in this month of October, November, you want to buy those dips. You want to get long, because I do think we're going to see 6,000 before the end of the year. This is the weekend sentiment poll, something we do on this channel every single week. If you're a subscriber, subscribe so you don't miss it. And on the weekend, I pose a question just to check where we stand for sentiment in this community. And I asked, for the Russell 2000, are you bullish, bearish, or neutral? And the results really did surprise me. Now, the overwhelming majority of you guys are very bullish on the Russell. In fact, 56% of you are bullish. However, a notable portion remains bearish, and an equal amount remains neutral. In other words, 44% of you guys are not bullish. And that is very, very telling, because while bullish sentiment can be a positive sign, this is ever more so telling. And I think it really goes to the earnings picture. If you actually have a look at pro forma EPS growth for small caps, so far for 2024, small caps have been a bit of a dumpster fire for earnings. In fact, they've relatively got more expensive as they have rallied. You can see that 9% negative growth in the first quarter, negative 18% in the second quarter, and negative 10% in the third quarter. We are going to see a huge uptick here in the fourth quarter, but still overall the full year 2024 looking very negative. Negative 4% in earnings growth, and the place to be for earnings at least is still large caps and mid caps, seeing very healthy earnings growth, and that expected to accelerate into the fourth quarter, at least from the third quarter where we are right now. And if you actually look at earnings over the last 5 years, the S&P 500 has actually seen a massive earnings driven rally, and we know this because the S&P 500 trailing 12-month PE ratio is 19% cheaper than what it was in May 2021 right here. At the peak of 2021, we were trading at 33 times trailing. We're now trading at 26 times trailing. In the same time, stocks are up 38%, and this is earnings growth, not speculation. If multiples get cheaper and stocks continue to rally, that is an earnings-driven rally. But where does that leave us with valuation on a forward 12-month basis. And right now, US stocks, or the S&P 500 pretty much, trading at 22 times, very expensive. However, you do have to look at the composition and makeup of the overall index. A large proponent of it is high growth, high multiple tech companies, and I do think those companies deserve a bigger multiple. US ex big tech, things look significantly better, trading at 19 times, the all country world index at 18 times. But if you just remove the US from the equation and look at the global market, we see that PE ratios and multiples are actually within their median range. Look at Japan trading at 14.5, Asia Pacific excluding Japan at 14, Europe trading at 13 times, emerging markets at 12 times, the UK at 11 times, absolutely crazy, trading like a third world country, and China, despite the rally, only trading at 10 times. And I think this is the CSI index. So if you guys are looking for value, we definitely do want to look at the global market. And generally speaking, a combination of continued economic growth with a rate cutting cycle tends to be positive for global equities. Now, you do have to play your cards right here because the global economy is not quite as robust as the overall US economy. So when investing into global stocks, pick the right countries. I tend to like Japan. I tend to like South Korea. I do like Denmark, Netherlands, and Switzerland too. Those are great countries. I also do enjoy the Australian market, but outside of that, guys, do be careful. Stuff like Germany, even though the German market has been very, very good in the last 10 years, the German economy is expected to fall into recession in the third or fourth quarter this year. So do pick your poison and pick it well. However, if there is no recession, global stocks tend to outperform, similar to US stocks, if we don't get a recession in a rate cutting cycle. However, when we do get a recession, things can be very, very choppy, sideways action 12 months later, and that is opportunity cost had you put your money somewhere else. And diving into the macro, looking at overall GDP growth in the last 5 or so years from 2019, very interesting data right now. The current cycle, which is this orange line right here, it pretty much takes us from 2019, the COVID situation, and how we have tracked thereafter. The current cycle is evolving in a more typical way relative to previous fiscal crises. We're actually tracking above the 2007 cycle and relatively in line with the average GDP recovery since 1950, telling us that the data we're getting is actually well within line after a significant crisis. And right now, third quarter GDP is tracking at 3.2%. This is the Fed's GDP now. And based on the current estimate of 3.2%, looking at the historical relationship of NFP to the Fed's GDP now, this means that in about a week and a half when we do get the NFP, we're looking at about 240,000 in NFP claims. The consensus is about 178,000. So if we do get 240,000, that's going to be a very, very big beat. That's obviously going to go to the overall stronger economic picture. And what we've seen is that 5-year, 10-year, and 20-year break-even inflation expectations have shot up significantly in the last couple of weeks. Now, this seems in part because of the reduced recession risk storyline. Break-evens normally track CPI, which runs about 30 to 40 basis points above PCE. So the current levels do match a PCE of 2%. However, you do want to look at the trend. The trend is up. And I do think in the short term, this is also driven by oil almost entirely. Fiscal spending and tariffs can be a big concern, but it also just has to do with the fact that the economy is stronger. And in the longer run, that is going to lead to slightly higher inflation. Now, CPI and PCE is on a downward trend. This is break evens, which is just a nominal yield minus the tips yield. And you can see this is where the Fed's target's at. And we were there in break evens, and the 2.5% range, which is the 30-year historical average, is at that level. So as long as we're below the 2.5% mark, we're all good. But if this trend continues and we do get to the 2.5% break-even rate, that's when things can look a little bit scary, because ultimately good news is good news. Stocks and rates can go up as long as inflation remains in check, and that means we continue to see disinflation. So CPI moving to its 2% target, PCE moving to the 2% target, and break-evens below the 2.5% range. If we get that, rates can move up and stocks can move up simultaneously. Diving into earnings, guys, tomorrow we have a very big day, particularly for semiconductors. We have ASML, a big barometer for the semiconductor industry. We also had Morgan Stanley, Abbott Laboratories, and US Bancorp. And then after the close, the only big name is Discover Financial. Tomorrow is the big data print. Retail sales is what the market's going to be paying attention to. Now, the core control figure is 0.8, at least BOFA's estimate. The consensus is 0.4. I think we have such a wide dispersion between consensus and BOFA's estimate because of what's happening with the strikes we're seeing in the US, as well as the hurricanes. However, I think the truth is somewhere in the middle. If we get a 0.6 number, that should keep the market buoyed. However, anything can happen because this data tends to be very, very noisy, especially when you do have massive events like strikes and hurricanes all at the same time. Now, less autos were looking at 0.7 and the advanced number 0.8, the consensus estimate 0.1 and 0.2 respectively. But if you've made it up until here, thank you so much for watching. If you like this video, please subscribe, hit that notification bell, as well as the like button, and leave a comment for the algorithm. Cheers.